Hello, everyone, and welcome to another episode of the Reinsurance Podcast. I am your co-host, Jerad Lee.
And wishing you happy Halloween, I'm your other co-host, Ben Rose. We've been told that this is going out on Halloween.
Yeah.
If it doesn't, happy Halloween anyway, in the past or the future. Next year.
Happy either belated or preemptive Halloween.
Which means that we've just been to Baden-Baden, and you're about to go to Singapore.
Yeah, I will be in SIRC in Singapore.
Very exciting.
So as you listen to this, fine listener, if you're in Singapore, just drop me a note right now. Stop what you're doing, pause the episode, and come say hi to me in Singapore.
I'm over here, behind that person. Yeah, that's me. And great to have seen you in Baden-Baden.
Yeah, exactly. Or missed you if you.
Or missed you. If we didn't see you, then I would have loved to.
But what we want to talk about today is dive into a bit more on, as we now at the end of October, we are certainly nearing like the sort of, we're in the depths of reinsurance sort of purchasing season for 1/1. What we wanted to spend some time talking about is understanding the insurance companies, their sort of how they pursue profitability, how they leverage reinsurance for that, and sort of the universe of topics that will sit around this kind of central point.
But especially adapted to the fact that this year things look different, right? We've just had the craziest renewal a year ago, well, not quite a year ago, 9 months ago.
Yep.
And this year people are figuring out what they need to do with their structures, with their coverages, given that for many people attachment points have been raised, some lower layers have gone missing altogether. People are worried about, sideways coverage, etc., turning to FAC, trying to think about what to do.
Yeah.
So we wanted to unpack in general, first of all, why are people buying reinsurance? Let's go back to basics.
Mm-hmm.
What are the reasons you would buy reinsurance to begin with? What were you trying to cover historically, and what might you be thinking about as you plan for a year where capacity maybe isn't as available as it once was?
Well, I think the thing that's gonna
Jerrad's shoulder.
Yeah, exactly. For those who are watching on camera, you can see I have a sling because I had not emergency surgery, planned surgery, but yeah.
So
just in time for Halloween.
So if your last year's structure is in the same state as Jerrad's shoulder,
banged up and needing repair. But I think just making a quick comparison, pausing from what you've just said, and last year was this environment where we knew the market was changing very, very rapidly, and everyone kind of scrambled to get their deals done, and a lot of things looked very similar, just a lot more expensive. And now that we've had sort of 6-9 months of this hard market in the rearview mirror, or been living in this hard market for this last year, the market conditions are still hard. But because people are able to go into this renewal season knowing that, we heard at 1.4 and at 1.6 that they were more orderly. Doesn't mean they were cheaper. It just means that everyone knew that going into it. And I think it's really interesting for this conversation because what the insurance companies are able to do going into this 1/1 is start from a very principled approach. Going, okay, we know we're going to be paying more for our coverage. So what are we trying to achieve with our reinsurance? What are the things we care about the most? What are the things we're trying to protect ourselves against the most? Prioritize those things, and I think that will make it a very interesting one from that angle. So with that additional context, let's dive into why do we buy reinsurance going into 1/1?
But it's a really, really good starting point, because I don't think people have been asking that for a while. Previously, it's been, how do I get my reinsurance for less?
Yep.
For 10, 15 years, probably. People have just had that ambition, right? How do I get the same set of structures, the same programs we've always had for a bit less than last year, because those structures were deemed fit for purpose, and now we are turning back to, hang on a minute, why did we choose those structures in the first place? And typically, it would have been for one of a handful of reasons. Obviously, there are quite a few beyond that, but typically, one, there's stuff that you don't want to keep. So we'll start with that one maybe as the first topic. All of us who are in the business of insuring pick up things that we didn't really want to keep as a risk. It could be especially dangerous drivers. It could be the risk of many perfectly ordinary drivers all having a big collision together in the motor world. It could be a business that turned out to be much bigger than the usual businesses that we'd provide business insurance to. It could be A set of mansion properties that, happen to be in the same neighborhood that you tend to sell insurance normally, who got involved, and if they did mysteriously catch fire, it would be a major event for your portfolio. Or it could be actually there are giant perils which lurk over your portfolio as a whole, and you're worried about some kind of event happening to your portfolio, in which case you want to protect against that outcome. So I'd say that's probably the first kind of coverage. And even within that coverage, I'm sure Jerad is already preparing to explain, there are lots of different kinds of product that can respond to step in and protect.
Yeah, well, and then once you know kind of what you're trying to offload or what parts of your book you don't want, you begin to understand or think through, like, why don't you want it, right? If it's a bunch of business that you're just generally unsure about, you might just want to split it up and say, well, I'm going to give half of this away. So I don't know enough about it to sort of have any more granularity or any more additional strategy around that. So I'm happy just to carve out a portion of that and give it to my reinsurance partners, and then we will work in partnership along this journey. Other books you might have a lot more understanding of, and you might understand that, the likelihood that you'll incur this amount of losses is this level, this percentage. Therefore, you're super comfortable taking a limit an excess or a deductible of up to this point, and then buying various levels of coverage up to the, up the chain. And then again, you sort of get an idea of what's the likelihood, what's the worst case scenario here. There's no point in buying $1 trillion worth of coverage if your book only has a TIV of, a few $100 million or something. So you begin to look at kind of what's the overall limit of your exposure, and kind of you think about the top or the likelihood that you get that high, and think about where you might stop buying reinsurance. But so that's how you begin to sort of think about, once you know what you're trying to get rid of or give away, then you think about the most effective, cost-effective ways for you to do that. And that's kind of how we've always have been sitting there. People have we talk about rinse and repeat renewals a lot of times, where, I bought that last year. My book is about the same. I'll buy the same thing again this year. But I think going into this renewal season, I think a bunch of insurance companies who have relatively static books will still look to reorganize and restructure kind of how they're buying their reinsurance.
Completely. And it was interesting. I want to just reiterate some of the keywords that came out of your summary there, because it's going to be very different to one of the other reasons for buying reinsurance that we'll come on to. But at what point, do we need to start getting rid of this business, or giving this stuff away because we don't want it? Where does our reinsurance coverage need to stop, etc.? What's the worst it could get? That's the kind of narrative that we're dealing with here, right? And what we've found this renewal season for this type of reinsurance purchase is that there's been a bit of pass the parcel or reverse tug of war. I'm trying to push of war. Basically, nobody wants this attritional bit in the middle. There's this section of losses that are kind of expected and happen with relatively high frequency, that are more than insurance companies have typically wanted to keep, but less than the reinsurers consider part of their duty, right? A lot of the reinsurers, their pitch to investors is, most years we have great results, and occasionally we step in to pay the very extreme rare claims that happen, and that's our role. And so a huge part of the narrative at Monte Carlo, and I'm sure also during Baden-Baden whilst I was there last week, has been around, we've had a reset this past renewal season that has returned the reinsurer to its proper role in an insurance or risk society, where now the reinsurer is actually back to accepting just the rarer key perils that it was there to protect, instead of being just this cushion that starts as soon as an insurance company starts getting any kinds of losses at all, right? And picking up all this attrition from secondary perils that they didn't expect to come in, especially as we've seen wildfires and severe convective storms adding extra losses to portfolios where the reinsurers really weren't expecting to be fulfilling that role in the past. So now we've had to transition for those insurers looking to buy reinsurance to offload risk they don't want to a market where they're only realistically able to get rid of the risk they really, really, really don't want, and are willing to pay quite a lot to get rid of, unless they're to be honest, I'd be happy to get chuck that way as well.
Yeah. If I can pause there and maybe explore like an adjacent tangent,
Yeah.
is do you think with the extended period of low interest rate environments and the sort of amount of cheap capital that was available for so long, that the insurance companies got a little bit greedy in buying things that as a way to sort of improve their balance sheets and almost like overbuying, like, you know, to your point, like
Yeah.
they went to a market that wasn't really there for that purpose and just overbought it because they could at the time.
Yeah.
And now the reinsurers are saying, that's not our purpose. We're going to sort of step back and resume our position of being just here for these extreme ones. And you have to navigate your own balance sheet, your own underwriting principles, and pursue profitability with us as the sort of final backstop, not as this, we just come in once you start even getting a little bit of a ding. Like, so that's interesting, right? It's almost the insurers like saw free money and just sort of padded their strategies with it in many ways.
Yeah, I think, ironically, sorry, we can edit out my coughing again. Basically, the amount that insurers have to spend on reinsurance is quite open to what they can get. Right? It's very dependent on the cost and the availability of reinsurance in the market. And I think what we saw in a decade-long period of falling rates, very, very soft market cycles, very competitive broker market where the brokers are all competing to get a better deal than their competitors for their clients, the insurance companies, was that the brokers were effectively able to throw stuff in for free and say, oh, we'll get you some of this if you choose us as well, or to defend their accounts, we'll get you a discount on that, and left these insurers with a ever growing capacity in their reinsurance budget for more and more coverage, which did change a lot of their reinsurance strategies. I think for more might as well buy whatever is available, a more opportunistic sort of purchasing. I think you see that actually happening again in a different way in the alternative capital market at the moment. Less we might as well, but basically what reinsurance is purchased is often based on what's available at the best price. So a lot of insurance companies have been buying cat bonds over the past couple of years as the retro markets become a bit more unstable and a bit more costly. People have defaulted to something that's cheaper instead. So it's been very interesting to watch how I guess there's a good word that I've forgotten again. Anyway, they're quite undependable, I guess. Fickle is the word I was looking for. They're quite fickle customers, insurance companies. They're not buying. They're buying very much with their wallets in mind.
Well, as we sort of go into, so now you have that dynamic, and you have a reinsurance buying community who's been sort of over the last couple of decades moving more and more into the buying whatever optimizing what you can purchase. And I think you'd always want to optimize what you can purchase, but over the last couple of decades, it's been optimized for purchasing the most you can with the budget that you have, where now it's going to be pivoting quite a bit the other way, where it's like, okay, here's the budget that we have. How can we ensure we're covering the things that matter to us the most? How do we make sure that we're prioritizing the parts of our book and optimizing our spend for our coverage, not optimizing our spend for the amount of it? It sounds very similar, but I think there's a nuance there of how they're thinking about this purchase.
And I think actually I think a lot of people are going to get this wrong, humbly, in that they assume that reinsurance budget is quite static. In the market we are in the insurance side, with the inflation in premiums and the growth that we're seeing, generally in demand, etc., in this market that we're in, I think most people should be looking at their reinsurance budgets as buyers and increasing them. Because they need more coverage. You don't want to be having to act as an internal portfolio manager and just taking on extra risk. you got to be loading more in and benefiting from the growth there, and being very, very aware of the fact that not only are we in a more perilous world on all fronts at the moment, but also we're in a position where those claims are going to cost a heck of a lot more with inflation built in. We're seeing people bolster casualty reserves in particular in preparation, on the reinsurance side especially. But as an insurer, it's probably not the case of like, oh, we'll trim back on all the extras and we'll be fine. It's like, no, this is a budget increase moment. Think more carefully about what you're going to buy and buy a bit more of it.
Yeah, well, and I think this is where the critical component of the data is going to come in, right? If you're an insurance company and you're wrestling with all of these things we've just begun to unpack, and you are unable to then articulate clearly what you want to buy, why you want to buy it, understanding your exposures. Now, it's equal parts giving that clarity to your reinsurer, so like your price is fair, right? Because if, again, we've talked about before, we did the white paper, again, you can get the white paper on the cost of bad data on our website, supercede.com, if you don't know. We do more than
they
just...
know. They know already.
They know already.
They're on there right now.
Go to your favorites and click the top one. But so there's the part of giving clear and clean data to your reinsurers so they can understand what they're underwriting and give you the best price. And doing that more quickly is obviously super, super important. But this other part that we have going into now is you're trying to understand, what are you buying? How critical is everything that you're trying to purchase? Do you need all of it, or do you not? Does a restructure help? Should you go out and procure or secure a greater reinsurance budget? All of those decisions are going to be driven by your ability to understand the data you're buying reinsurance on. And if you have mountains of spreadsheets that are taking you months to interrogate, and someone says, can we get away with not buying this? Can we get away with moving this up? Can we get away with trying to do less, or and your answer is, like, you're going to have a hard renewal season. And so I think this is why we're seeing such a massive increase in people coming to us. But there's this recognition that when we were in the fat times, it's about the same. We kind of get, the premium's going to kind of climb another 11%, and off we go, and you just go and buy whatever you can get. But now, when that purchase doesn't only require more scrutiny from the reinsurer about what you're bringing them, but it requires more scrutiny internally as you try to articulate to the group, to the board, about what you're buying and why and what your needs are. That needs to be evidenced. Yeah. Especially if you're trying to get a bigger reinsurance budget, which is not going to be an easy conversation.
Completely. And I think a lot of times it'll be not due to a lack of willingness from the brokers either, who are very much there saying, help us to help you, right?
Yep.
But there's only a limit to what they can do.
For sure.
If you can't give them the data that they need to be able to pitch to you, well, what about buying this structure?
Yeah.
In order to work out whether it's a good idea or not, though, you will have to give us, some of the underlying portfolio information.
Yeah.
And that's the bit that is slowing down the whole system at the moment, because either the data that goes in is really out of date because they had to get it so many months in advance, or it's coming so late in the process that, our quoting markets don't have time to turn around the alternative structure as well as the old one before the 31st of December. So maybe next year. Yeah.
Well, and the other thing that's happening alongside this, so we've talked at a very kind of high level around just limits and coverage and price and these sorts of things. But the other thing that sits within here is the contracts themselves. But where I'm going with that is things like sublimits, things like geographical exposure limits, and these types of things. And as you're trying to as a reinsurance buyer, buy the most important coverage that you need for this next year, and the price is going to be higher, if you can set reasonable sublimits and say, well, we don't need to include that at this layer, those types of things will be impactful for what you buy and the price you pay for it. But if you're unable to interrogate your data and say, oh, we know for a fact that this how much sits here, we can carve these pieces out, we can set sublimits there because we know it's not too impactful to the book. Anytime you can do that, that's going to be an asset to you. But if you're kind of going, all I have is just the lump.
Yeah,
And
yeah.
there's the big number, and you can't do anything more. You can't drill in further, or you can't drill in further within a reasonable time frame by which you can go into the market and have that conversation. You're going to be just stuffed, like bringing out the entire bag and saying, here's everything I'd like a cover to hear, with no ability to then introduce sublimits and all these things which will help reduce your overall premium exposure.
And it's when deals get really complicated like this that you really need cedent broker and reinsurer like a way of tracking your deals over time and comparing them all to each other in all their glory, so that you could see in a single place all of your reinsurance.
Where does it all sit? Where does it all do?
If only.
How's it coming along?
If only there were a solution. But let's move on to the other kind of side of reinsurance purchasing. So we talked a lot about getting that critical coverage that you need. You gave a good example where some people might end up with risks they don't want because they've ended up with it almost. And maybe some listeners were thinking, well, hang on, why did you write that business in the first place if you didn't want it? I think what we forget is that insurance companies, if you sort of unbundled them, are a set of capabilities for taking on and pooling and pricing risk. As everything from the advertising, the relationships with distribution partners, the online sales streams that they've got, call centers, claims teams, etc. There's an amazing group of resources that reinsurers don't have. And that's important, because what happens then is that the insurers sometimes find themselves in a position where they can leverage that usefulness in a market to take on lots of business because they have access to customers who want stuff. Maybe they're already selling customer A motor insurance, and then it just seems silly not to sell them home insurance as well, right? They might not actually want any of the home insurance, but they know some people who might want a share of that who are in the reinsurance market. So what you can end up with is reinsurance almost being sold as a deal, being sold by the cedent to the reinsurers rather than the other way around. Because not the cedent looking for coverage, almost it's the reinsurers looking for risk.
And this is going to be one we'll spend more time unpacking, and we'll follow this renewal season as we do all renewal seasons, unpacking sort of what we're seeing, what kind of things are driving it. But the takeaway lesson is the data matters, and this now more than ever, the data matters. So if your data isn't very good, you don't think it matters, again, come to our website, we'll sort you out. But this is a super important one going into this renewal, and we're going to see how this all shakes out. But happy Halloween, everyone, if that doesn't scare you enough.
Reflected in Jerad's eyes, I can see Cordy waving his
time
kicked out of the studio, unfortunately. But yes, whether you are looking to get reinsurance to protect yourself, or you want to sell your fabulous insurance risks to anyone, you do need great data.
You do. Yeah. So with that, till next time, everyone, thank you so much.